All right, everybody, welcome back to the deep dive.
Yeah.
Today we're diving right into the wild world of the stock market.
Oh, yeah.
Specifically, Monday, April 7th, 2025.
That was a day.
A day that a lot of people are going to remember.
Absolutely. And we have some really fascinating reports, actually, from the Motley Fool from that day.
How cool.
So it's like a real play-by-play of the trading day.
Wow.
You know, from the analysts and the folks at the Motley Fool, kind of giving us a little bit of an inside look.
Oh, that's cool.
Yeah.
I like that behind-the-scenes feel.
Yeah.
So what we're going to try to do is unpack what happened. What are the implications for us as investors? And maybe, give you some ways to think about all of this volatility without, getting too stressed out about it.
Yeah.
So April 7th, it sounded like anything but, a normal Monday.
Oh, absolutely not. It was a real roller coaster of a day.
Oh, wow.
I think that's kind of the phrase that really captures it.
Yeah.
For these big swings up and down all day. And the S&P 500, ended the day down just slightly, but it was the third day in a row of losses.
Oh, no.
And it kind of pushed the index, closer towards what people call bear market territory.
Oh, yeah. That's the phrase that, a lot of investors, I think, don't like to hear.
Yeah.
So can we just remind folks, what bear market territory really means?
Absolutely. So generally, when we talk about a bear market, it means a major stock index like the S&P 500 or the NASDAQ, has fallen by 20%.
Okay.
Or more from its most recent high point.
Got it.
And actually, in these reports, we saw that the NASDAQ was also likely, headed into that territory very soon.
Wow.
So it wasn't just, one little area. It was kind of a broader downturn.
20% is definitely not a small little dip.
Yeah, no.
So what was behind this big drop? It seems like trade, specifically tariffs, was a major player.
Oh, yeah, absolutely. Without a doubt, the escalating discussions and the threats of new tariffs, particularly with China,
right. Yeah.
were immediately identified as the trigger here. There was the potential of an additional 50% tariff on Chinese goods, and that was supposed to go into effect April 9th.
Oh, wow.
And that was on top of the existing 34% retaliatory tariffs.
Okay, so it was like a
1-2 punch almost.
Right, okay.
And the message was basically, roll back these tariffs by tomorrow, April 8th, or else
50%.
50%, yeah.
So, that's a pretty tough negotiating tactic.
Yeah, it definitely created this, pressure cooker environment.
Right, but they were saying that they were open to discussions with some countries.
Yeah, absolutely. The Treasury Secretary, Scott Bessent, did say, the White House was open to meaningful negotiations with over 50 countries, actually, that had responded positively to the tariffs.
Oh, wow.
But the key thing here is that China was not included.
Oh, interesting.
In this initial group.
So they were really putting the squeeze on China.
Yeah, it seemed
trying to, get some concessions out of them.
Absolutely. So it was a much more targeted approach than...
Not just like everybody.
Yeah.
Not like a blanket, everybody gets hit.
So that was that underlying tension creating all this worry.
Yeah.
Now, there was this head fake incident that caused the market to rally for a bit.
Oh, yeah.
Can you unpack what happened there?
Yeah, this is fascinating.
Yeah.
It just shows you how fast markets can move.
Right.
Sometimes based on really,
nothing.
Not great information.
Right.
But it's this age of social media, right?
Yeah. So information travels fast.
It all stemmed from some comments by Kevin Hassett, who's a White House economic advisor, during an interview on Fox News.
Okay.
And those comments then were kind of picked up and misinterpreted on social media to suggest there was this potential 90-day pause on tariffs.
Oh, wow.
And people kind of jumped on that thinking, oh, maybe tensions are easing.
Yeah, and so the market shot up.
Yeah, there was this brief surge.
But the White House very quickly came out and clarified and said, actually, no, that's not happening.
Got it.
And, of course, then...
Back down it went.
Yeah, it was this classic, rumor mill.
Right.
Sending the market one way, then reality hits. And
yeah, and it was Tim Byers from the Motley Fool who said markets will move massively for nonsensical reasons.
Absolutely. And I think that's a great lesson for all of us.
Yeah, don't react to every headline.
Yeah, exactly. There's time to assess the situation.
Right.
Especially for those of us who have long-term horizons.
Right.
We don't need to
panic every second of the day.
Yeah, exactly.
Okay, so fear was definitely in the air that day.
Yeah.
Another indicator of this was the VIX, which is Wall Street's fear gauge.
Right.
Had a big jump.
Yeah. The CBOE volatility index, or the VIX as people call it, climbed 6% to around 48 on that Monday, and actually it even topped 60 during the day.
Okay, so that means...
I mean, think of it as this.
Like the market's expecting huge swings.
Oh, exactly. Right? It's basically the market pricing in how much they think stocks will move over the next 30 days. So when there's a lot of uncertainty, a lot of fear, the VIX goes up.
Makes sense.
And when things are calmer, it goes down.
Correct. So that's a pretty high level, 48 to 60.
Yeah. To give you an idea, it's only closed above 50.
Wow.
Twice in the last 20 years.
Oh, wow. Okay.
So once during the 2008 financial crisis.
Makes sense.
And then again, early 2020 with COVID.
Right.
So that just gives you an idea of...
Yeah, that's a lot of fear.
Yeah, there was a lot of anxiety.
Right.
Expecting some potentially big moves.
And it wasn't just the U.S. markets feeling this, right? Emerging markets also took a hit.
Yeah, they did. They saw a pretty substantial drop, an average of about 8.4% decline.
Wow, in one day?
In one day, yeah. And it was actually their worst day.
Wow.
Since the global financial crisis.
Okay, so that gives you a sense of how big this was?
And, the hit was particularly severe in Hong Kong.
Okay.
Where Chinese shares listed there fell 13.8%.
Oh, my gosh.
Pushing them into a bear market.
Okay, so... They hit that 20% threshold.
They did, yeah.
And it wasn't just Hong Kong. Other Asian markets, Japan, South Korea.
Yeah, all the major markets.
Took a dip.
Yeah, and it just shows you how globalized our financial system is and how these tensions between the U.S. and China can have these ripple effects across the world.
Yeah, I mean, 13.8% in a day is...
Yeah, that's a huge move.
That's a really big move.
Yeah.
So in the midst of all this, what were some of the strategies people were talking about?
Right.
I remember seeing something about dividend stocks.
Yeah, so Matt Argersinger from The Motley Fool talked about the importance of dividend-paying stocks during times of volatility.
Yeah.
And he kind of highlighted two main reasons.
Okay.
Why they can be beneficial.
Yeah.
First, those regular dividend payments can really act as a buffer. Yep. They can kind of cushion the blow to your portfolio when stock prices are falling.
You're still getting a little bit of income.
Exactly. And, secondly, those dividends provide an opportunity to reinvest at lower prices.
Oh, that's interesting.
So when stock prices are down, you can take those dividends.
Right.
And you can buy more shares.
For the same amount of money.
For the same amount of money. And then when the market recovers...
That could really pay off.
That can really help you.
Yeah. Okay. That's a really interesting way to look at it.
Yeah.
Were there any examples of dividend stocks that were doing well?
Yeah. So he pointed to a couple of ETFs.
Okay.
The Dividend Aristocrats ETF, which is ticker symbol NOBL.
Okay.
And they focus on companies that have increased their dividends.
Oh, wow.
For at least 25 consecutive years.
Okay.
So very consistent dividend payers.
Right.
That ETF was actually down less than 5%.
Oh, wow.
Year to date at that point.
Compared to,
much better.
The broader market.
Way better than the broader market, yeah. Okay.
And then he also mentioned the Schwab U.S. Dividend Equity ETF.
Got it.
Ticker symbol SCHD.
SCHD.
And they're looking for more of a blend of high dividend yield and dividend growth.
Right.
So they want to see those dividends increasing over time.
Okay, so they're not just, standing still. They're
yeah, exactly. They want to see
actually going up.
That growth as well.
Okay, interesting. So switching gears a little bit, Larry Fink, the CEO of BlackRock, had some pretty serious concerns.
Yeah, he did.
Didn't he?
He warned that stock prices could potentially fall another 20%.
Oh, wow.
From where they were that day.
Okay.
And then he also said that, a lot of the CEOs he'd spoken to thought the U.S. was already in a recession.
Oh, no. And, of course...
He's the CEO of BlackRock.
Yeah, BlackRock is the largest...
10th manager in the world.
Pretty good view of what's going on.
Yeah, they really have a pulse on the global economy.
Right.
And actually, their earnings were due out later that week.
Oh, okay.
So everyone was kind of waiting to see.
People were really listening to what he had to say.
Absolutely.
So, that's a pretty serious outlook.
Yeah.
Another 20% drop and,
Yeah.
Maybe we're already in a recession.
Yeah.
It's no wonder people were nervous.
Right.
Now, there was also something about how small-cap stocks were doing particularly poorly.
Yeah, so Bill Barker, another analyst of The Motley Fool, explained that the Russell 2000, which tracks these smaller publicly traded companies, was getting hit harder than the larger cap indices.
Okay.
And the reason for that is
why is that?
These smaller companies are much more reliant on the U.S. economy.
Oh, okay. So if the U.S. is
slowing down,
going into a recession, they're
they're going to be hit harder.
Got it.
And they also tend to carry more debt.
Okay.
Which makes them more vulnerable.
So they're more exposed to a weakening economy.
Absolutely. But there was a silver lining.
Right.
Something that could help them down the line.
Yeah, so Barker pointed out that if the Federal Reserve starts cutting interest rates, that could eventually provide some relief to small cap stocks.
How so?
Well, lower interest rates
would
make it cheaper for them to service their debt.
Got it.
And could also potentially stimulate the economy.
Yeah.
But, on that day,
right.
those immediate fears about the recession seem to be outweighing any optimism about future rate cuts.
Right. Okay, so a lot of uncertainty, a lot of competing factors.
Yeah.
Now, we also talked about a former Fed official.
Yeah.
Bill Dudley.
Right.
And he had a pretty pessimistic view.
He did. He suggested that stagflation was now kind of the best case scenario.
Stagflation. So for folks at home, that's...
Yeah, stagflation is...
high inflation and slow growth.
That's a nasty combination.
Right. Yeah, that's a tough environment to be in.
Yeah, it really is.
Especially, for people trying to afford everyday things. Prices are going up.
Yeah.
And, jobs are harder to come by.
Yeah. Not a great situation.
Now, how are investors feeling overall?
Right. So 2 key measures of investor sentiment were really flashing red.
Okay.
One was the American Association of Individual Investors, or AAII.
Okay.
And their survey showed that almost 62% of investors were bearish on the market.
So bearish meaning negative.
Yeah, meaning they think the market's going to go down.
Yeah.
And historically, that number's closer to 31%.
Wow. Okay, that's a big jump.
Yeah, it was a really big jump.
Okay.
And Andy Cross from The Motley Fool pointed out that this was actually approaching the level of bearishness that we saw during the 2009 financial crisis.
Right.
Which, in hindsight, turned out to be...
a good time to buy.
Yeah, a really good time to buy.
Okay.
So it's almost like...
when everybody's negative, that's maybe when...
maybe that's a sign.
you should be buying.
That the bottom might be near.
At the bottom.
Yeah, and then the other gauge was the CNN Fear and Greed Index.
Okay.
And that was also near its lows.
Okay, so really
a lot of fear in the market.
Yeah, so what were some of the business leaders saying?
Yeah, so we heard from Jamie Dimon.
Right, the JP Morgan CEO.
The CEO of JP Morgan Chase.
Right.
He warned that the tariffs could lead to slower growth and higher inflation.
Okay.
Although he did say it wasn't clear if it would cause a recession.
Yeah, okay.
And then we also heard from Stanley Druckenmiller, the billionaire investor.
Yeah.
He said he was opposed to tariffs exceeding 10%.
Okay.
He said anything more than that
could
be really damaging to the economy.
Right.
And then Bill Ackman
Pershing Square.
from Pershing Square,
Yeah.
he actually called for a 90-day pause on the new tariffs.
Mm-hmm.
He said, imposing all these trade barriers was a mistake.
Okay.
So there was a lot of concern
it seems
from these leaders about the potential negative fallout from the tariffs.
Okay, so what were the folks at the Motley Fool recommending?
Right. So Andy Cross, the CIO of the Motley Fool, really emphasized the importance of looking at history.
Okay.
He said, look back at times like 2022, the 2008-09 financial crisis, even the 1987 crash.
Wow, okay, going way back.
And his main advice was don't panic.
Okay.
He said, these times of pessimism and fear often present the best buying opportunities for long-term investors.
So he was looking at it as like a potential opportunity.
He was, yeah. He said he was looking to buy during this downturn, with a focus on investments that he could hold for years, not just months.
Be greedy when others are fearful.
Yeah, exactly. And that's that classic Warren Buffett line.
Right.
But it's, it's hard to do.
Yeah.
But it's really good advice.
Now, we talked about how the U.S. market was down.
Yeah.
But the report also mentioned how the international markets had plunged overnight.
Yeah, it was a really rough start to the day.
Okay.
Globally.
Okay.
The sell-off overnight was so intense that it triggered circuit breakers in Japan, South Korea, and Taiwan.
What are circuit breakers?
They're basically these temporary halts in trading. Designed to prevent panic selling when prices are falling really rapidly.
Got it.
And then the Japanese Nikkei, it fell sharply right at the open, entering bear market territory. European markets also opened down around 6%.
Okay.
And even before the U.S. market opened,
Yeah.
S&P 500 futures were down almost 4%.
So it was like the writing was on the wall.
It was. Yeah, you knew it was going to be a rough day.
Right.
And it just shows that,
Everybody was nervous.
yeah, that negative sentiment was global.
Now, what about Treasury Secretary Bessent's comment about President Trump creating maximum leverage.
Right. So he said that in the context of these trade discussions with these 50 other countries. And he basically said that, a lot of these countries have approached the administration about lowering their own trade barriers and reducing tariffs on U.S. goods.
Interesting.
And ending currency manipulation. And he specifically mentioned upcoming meetings with leaders from Israel and Japan.
Got it.
Where trade was going to be a key topic.
Makes sense.
Especially because there was this new 17% tariff that had been put on Israeli imports.
Okay.
So his point was that the president's actions, while they were causing short-term market disruption, had actually put the U.S. in a
strong position.
Stronger negotiating position.
Right. Okay. Interesting.
Yeah.
So now Sanmeet Dale, another analyst from the Motley Fool, he really focused on the long-term opportunities
he did
that this volatility could create.
Yeah, he said, these periods of volatility can feel really unsettling in the short term.
Yeah. Nobody likes seeing their portfolio.
Nobody likes it.
Drop 10% or whatever.
Right.
Yeah.
But he said they often present the best chances for long-term investors to build wealth.
Okay.
He pointed to data showing that after big spikes in the VIX, like the one we saw on April 7th, the S&P 500 had historically delivered really strong returns.
Okay, how strong are we talking?
Over the next 3 years, about 39% on average.
Wow, that's...
Yeah, so pretty significant.
Yeah, that's really significant.
Yeah.
He's saying, stay invested.
Yeah.
Be patient.
Time in the market beats timing the market.
Right.
And he also quoted Warren Buffett again.
There he is again.
Be greedy when others are fearful.
It's hard to do.
It is hard to do.
Yeah.
But if you can, these periods of stress can create a lot of opportunity.
Right. Now, not all the analysts were in a buying mood, though, right?
Right. David Meyer from the Motley Fool.
Okay.
A little more cautious.
Makes sense.
He said this is all unprecedented.
Right.
Nobody knows how things are going to play out.
Yeah.
And he noted that a lot of investors were moving money out of stocks and into safer assets like bonds and money market accounts.
Right.
And he said, personally, he wanted to see more fear in the market.
Oh, wow.
And lower stock prices.
Okay.
Before he really started buying again.
Got it.
And he made the point that, with interest rates above 3%, you could actually earn a decent return just by waiting.
Okay. So it's like he's saying, why?
Yeah.
Why take the risk?
Yeah. Why jump in now?
When I can get a pretty good return.
Exactly.
Just by sitting on the sidelines for a little bit.
And let things settle down a bit.
And see what happens.
Yeah.
Okay. So a much more, cautious approach.
Yeah, I think so.
Finally, the report touched on that bear market definition again.
Yeah.
And it said the NASDAQ was likely to enter bear territory soon.
Right.
And it really just emphasized the importance of that long-term perspective.
Absolutely. Tim Byers urged investors to consider their long-term goals.
Right.
And ask themselves, do these market events really change my long-term outlook?
Right.
If not,
maybe
the best thing to do is just take a step back.
Right.
Don't get caught up in the day-to-day noise.
Don't panic.
Yeah.
Sell.
Yeah.
Stay the course.
Yeah.
Exactly.
So to sum up our deep dive into April 7th, 2025.
It was a day of...
a crazy day.
A lot of volatility.
Yeah, driven by those tariff policies and the uncertainty.
Yeah, a lot of fear in the market.
Absolutely.
Spreading across the globe.
Yeah.
Leading to some pretty big price swings.
Right. And we heard different viewpoints on how to react to all this.
You did, yeah. Some experts were worried about further declines.
Right.
Even recession or stagflation.
Yeah.
While others saw this as a potential buying opportunity.
Yeah.
For those long-term investors.
Right. Who could stomach the volatility?
Right. So it's all about, having a plan.
Yeah.
And sticking to it.
Yeah, and not getting too caught up in the short term.
Absolutely.
Ups and downs.
All right. So a really important question for you, the listener, is, given what we know about how markets have recovered in the past after these periods of volatility, how does understanding these cycles influence your own financial strategy?
Yeah, that's a great question.
Yeah. And how do you make decisions when things get a little crazy?
When the market throws you a curveball.
Yeah. Definitely something to think about.
Yeah, absolutely.
As you continue your investing journey.
All right. Thanks for listening, everybody.
That's it for this deep dive. We'll see you next time.
See you later.